As you scroll through YouTube, you're probably bombarded with countless content regarding dividend stock investing. Of course, it sounds like a dream. Who doesn't want passive income through dividend stocks? Quite simply, dividend investing involves investing in companies that offer cash distributions. Many dividend investors roll their distributions back into their investment to collect or even increase their wealth over time. As good as it may sound, it does have a bad side, and we'll tell you why. Hey, welcome to Stock Market Mate. Today, we'll talk about everything that's wrong with dividend investing. But before we start the video, make sure to subscribe to the channel and hit that notification bell to help us beat the YouTube algorithm. If you're done with that, then let's get right into it. According to Warren Buffett, the biggest mistake that most YouTubers and even seasoned investors make is buying stocks just because it pays out a lot of dividends relative to its share price. He also adds that buying stocks for the sole benefit of dividends is a foolish thing to do. This is what we'll discuss first. Dividends are often misunderstood. The problem is not really caused by the dividends itself, but by many investors who bring such misconceptions. Not everyone understands this type of investment. First of all, not because it is a high-yielding dividend means that they're automatically good for you. In general, a dividend investor will obviously want stocks with higher yields. However, you should know the catch. Risk and volatility usually come with the highest-yielding stocks. Another one is the misconception that dividend stocks are bonds. They're not. Dividends are not guaranteed. The dividend yield of a stock is just the average historical dividends that the company previously paid. Simply, there is absolutely no guarantee that the company will pay the next dividends. Companies have the power to change the dividends that they pay on each period. If the company is running bankrupt or short on money, then they can choose to entirely cut the dividends. Lastly, you should know that dividend stocks are not safe as you think. While most stocks with a commendable dividend history are safer than the typical stocks in the market, not all stocks with good dividends are safe. In the past, some stocks with good dividend histories have completely collapsed. Next would be low historic performance. While cash dividends sound like the greatest strategy to become rich with minimal effort, we don't really have a solid way to predict returns. Unfortunately, dividends fail the historic performance test. A plethora of investment data must be present to show how and why investing in something makes sense. Stocks, for example, have generated investment over and above inflation. On the other hand, dividend-paying stocks have provided less returns compared to other stocks. Dividend investors think that companies that are accompanied with good dividend-paying history automatically ensure bigger future returns. In practice, dividends do not explain future returns. However, a few dividend portfolios did perform better in the market, but this was never because of dividends, only to the factors that the investors were focused on. Dividend stocks are expensive. Almost every new investor is attracted to dividend investing, especially in the United States. This urges the companies paying dividends to increase their prices to ride with the popularity. These days, the biggest dividend-paying stocks are so hefty in price simply because they pay dividends, and so many investors are buying into them regardless of their expenses. If you compare the price-to-book ratios or price-to-earnings of the most popular dividend funds, you'll find that they are sometimes more than 50% more expensive than the average stock in the market. On average, keeping your investment costs low is the most basic way to gain the best investment return. When you pay less to invest, you keep more money for yourself. The math is pretty simple. People that are consumed by dividend investing tend to ignore their costs. A more diversified fund is most of the time cheaper than a dividend-centered investment fund. In the long run, your costs will eat your earnings away. The sad part is that you may be earning dividends, but if you calculate it, you've actually spent more on the dividends worth than its actual returns. Dividends force you to withdraw. You'll probably get huge sums of cash when you're investing in dividend stocks. You get to choose when to get the cash when you're focused on growth. Experts suggest that all your money should be in the stock market during the accumulation phase, and when you receive a dividend, go to your broker account and reinvest it in the stock market. On the other hand, capital gains stay in the market. They have the advantage of letting you choose when you want to get the money out of the market. Some people argue that during a market crash, receiving dividends rather than selling shares is way better. However, they're both the same thing. If you get dividends from a stock, the value of the stock will lower accordingly. It's the same case if you sold shares of a company. Reduced diversification. The value of diversification is so pervasive it has become a basic knowledge in the investment world. Still, it bears the moral lesson that you should never put all your eggs in one basket. If your investments are focused on stocks, you are limiting yourself to a subset of the stock market. You're simply doing the opposite of diversification. You're concentrating your investments into just one type of company. This makes your investments riskier. As you may know, diversification is a very effective way to increase your returns and reduce the risks in your portfolio in times of volatility in the market. So how should you invest in stocks? Well, there are two ways to invest in dividend stocks, and this is to number 1, invest directly in the stocks. Number 2, invest in dividend funds. Choosing any of the two will have lower diversification than investing in the whole stock market. If you invest in a fund, you will likely have a better diversification than when you choose to invest in stocks. However, you will still get limited to only some companies that pay dividends, and you should be informed that a lot of good companies with great returns rarely pay dividends. Some investors say that you don't have to own 50 stocks for the sake of diversification. This is true for the returns part of diversification, but diversification also lessens the dispersion of your outcomes. Quite simply, a well-diversified portfolio is bound to hit its average outcome. On the other hand, a portfolio with lower diversification probably won't reach its average outcome, and this dispersion is still reduced even when you already have plenty of stocks. So if you think dividend investing follows the safe route, let us caution you. Focusing on dividends has its own set of risks. Let's not forget that it was the very same excitement for dividend-paying companies that caused the stock market bubble and poor stock market performance of the 1970s. Dividends are not tax efficient. Dividend investing is accompanied with hefty tax consequences. The intensity of this drawback heavily lies on where you live. In some countries, dividends are taxed as income. They aren't even taken on a fixed rate, but it depends on your marginal tax rate. So if you're a person with a steady huge income, then be prepared for your dividends to be taxed at 30% or more. This is a very significant amount of investing. Furthermore, if you receive a lot of dividends, your marginal tax rate increases along with it. Companies that reinvest their profits will give back investment returns without immediate tax consequences, but that doesn't mean you won't eventually pay for it. As you see, this factor has to be considered as it can hurt your investment returns. So should you steer away from dividends? With everything discussed, you must be wondering if dividend stock investing is worth it. Should you avoid dividends? Of course not, but it all depends on you. Dividends are actually an essential part of total returns, and they always feel fulfilling to receive. In fact, they can be extremely useful when your retirement comes. However, you do have to avoid investing in companies based solely on their dividend history. We should invest in the broader stock market with low-cost index funds. This is the most efficient way to invest for more investors. At the end of the day, dividend investing is in essence just like stock picking. If you found this video helpful, kindly click the like and subscribe button. Also, you might want to leave a comment below. We love hearing from you. Thank you for watching, and we'll see you in the next video. If you enjoyed this video, you're going to want to watch one of these two videos right here. Enjoy!